So we are looking at IFRS 2 share-based payment. It's English, as the name implies, it is share-based payment. Now, let me start by giving you some practical and, realistic examples. Let me ask you a question. Let's say if you buy a good, a good, or let's say anything you buy, or you contact somebody to do a service for you, and the cost is, or let me use the good. Let me use the goods. So if you buy something from someone and you pay cash, let's say the cash is 5,000 cedis. What do you think the double entry will be? What will be the double entry? You bought a good and you paid cash of 5,000. This is 5,000.
You debit the items and credit cash.
Okay, so debit the item. So let's say a purchases, right? Or let's say if it is whatever it is, whatever that asset is, and you credit what? Cash. So this is debit what comes in, credit what goes out. This is senior high school. Now, I buy these same goods. But I'm not paying cash. I'm giving equity instrument, like my share. Shares are priced at fair value. So let's say the fair value is 5,000. What do you think the double entry will be? Yes, the same thing. But this one, I didn't pay cash. I said that, please, you have an equity stake for 5,000. What do you think the double entry will be?
So now you credit equity.
So you debit the asset or the
purchases,
P&L or whatever, P&L or assets. The same thing here. 5,000. And now you credit what? Equity. Yeah. So basically, that is what we are coming to do. So the idea behind share-based payment is that when people buy goods and they pay cash, normally this is the transaction, this is how it's done. But they are not going to use cash to pay. They are going to use shares to pay. So that is what we call share-based payment. Now, and that is a problem because you see, when you paid cash, it's 5,000, but the share price is not always at a constant 5,000. You know, share price goes up and down. You know that. Today, yes, the value of the share, tomorrow it can be 3 or it can be 6. So that is the dynamism. All right. Those of you doing audit, you realize that one of the things we talked about in dealing with the agency problem is corporate governance and also using share-based payments, all right, for their remuneration of directors, so that the directors, anything they do, they will know that they are also part owners of the company and they will not misbehave themselves. So this is like contacting a service. And when you contact a service, like let's say an employee, all right, employee, a typical example is the director, all right, and instead of paying him salary or bonus and using employee benefits to record a transaction, you will say no. Okay, so this is an antithesis to the employee benefit. Instead of giving the employee a benefit so that we can use IAS 9 to treat it, you will say no, I will give him a share. Okay, So in that case, we will debit our expense. However, the credit will not be a cash. It will rather be an equity. So that is what we are trying to say here. That is the basic understanding I can give you about the share-based payment. All right. So please, any question at this point before I move on? Any question? But you see, the problem is that, like I said, share price can be, let's say today it can be 4, tomorrow it can be 5. But you see, accounting is transactions are recorded as and when they occur, not as and when cash and cash equivalents are given for it. So this one means that if you postpone the tenancy, so at the point where the person wants to take his share as a payment for his service that is commanded, he conducted for you, he's going to use the share price. This one, you don't, so you say, I'm giving you 5,000 number of equity shares. So that number of equity shares, what is the price of the equity share as at the time we were doing the agreement? If it is 4, I'll multiply it by 4. I'll multiply, so when you multiply it by 4, you are like, is it 20,000? So the debit will be 20,000, the credit will be what, 20,000. If assuming I've made this 5,000 as a number of share, not the value. All right, so that is what happens. So what if our reporting date is this date? The date that we are preparing our financial statement is this date, where the share price has moved from 4 to 5. What then happens? All right. So these are the things we are going to be looking at. So in IFRS 2, share-based payment, there are 2 types of share-based payment. There are 2 types. And that is what we are looking at. Number 1, we have the equity-based share-based payment. Please, I'm going to represent share-based payment with SBP, okay, share-based payment. All right. Then we have the cash settled. So you can call this one equity settled share-based payment. We have the cash settled share-based payment. Okay. We also have another one, which is hybrid. The hybrid you can use to do the combination of the 2. But unfortunately, this is beyond our corporate reporting level. All right. So these are the 2 that we are looking at. Now, if you look at equity settled share-based payment, what we are saying is that you acquire a good or a service or a good or good, but you are going to use an equity instrument. So you are acquiring it in exchange of what? An equity instrument. Okay, a typical example of equity instrument. So here we are looking at IFRS 9, sorry, IFRS 9. So we are talking about shares or share options. Okay, then when we look at the cash settled, so this one too, it is equity, but the cash of the equity is valued on the fair value of the price of the equity, the share. So that is what you do. So here you are giving some number of shares, all right? But here to the same, what is happening is that the entity will acquire a good or a service. A good or service in exchange for cash measured. That is what we call it, an amount. In exchange for an amount of cash. But that cash, so how much is the cash? The cash is measured by reference to the share price. entity share price. I'll show you the difference between the two now. Now let's look at the accounting treatment of this one. So this one, we are saying that I buy good from you. So once I bought the good from you, I have given you number of shares. I didn't give you the price of a share. I said I've given you the number of shares. So what I'm saying is that I've bought pen from you, but instead of paying you cash, I am giving you 500 shares. So that at some point in time, you'll be benefiting from the returns on equity, or if you decide to sell the shares when it becomes yours, then you benefit from whatever you have, all right? So over here, what is happening is that the accounting treatment will just be to debit the P&L with the expense. In this case, if it is a asset, you debit, so you debit P&L, statement of profit or loss, or if it is an asset, you debit, and if you use the share base to buy an asset, you debit the asset. Then the credit is equity. But the equity we are talking about, we are not talking about stated capital, because stated capital comes in when people invest money. Yeah, but this capital that we are talking about what we call it the other component equity. Other component equity. In short, we call it the OCE. All right, other component. Please bear in mind that at this point, the share capital is not affected. What we call share capital, stated capital, is not affected. It goes to other component equity. But over here, what we are trying to say is that I've bought the thing, so okay, I will debit my SPL, or if there is an asset out. But you see, I'm not going to pay you the money, the cash now. I will say that, okay, what I'm going to pay you is the fair value of my price. So you create a liability. So let's say you sold the thing, and instead of paying the person, you say, oh, I will pay you in, let's say, 2 years' time. And the price I will pay you will be the value of my share price. So if the cash I'm supposed to give you, the value of my share price in 2 years' time is 4, then it means that I'm going to pay you cash, but the reference of my cash will be the share price of the entity as at the time the payment is being made. So you see this one, what you do is to create a liability, but the value of that liability is based on the share price of the entity. All right. What is happening is that I bought something from you. I'm going to pay you, but how much I'm going to pay you will be dependent on the value of my shares. All right. The value of the shares that I'm going to pay you. All right. So these are the two main branches of IFRS 2 share-based payment. All right. So please, I'm going to ask again, if there is any question, ask, let's clarify. We are moving on. We are building on something. So very soon we will be dealing with the figures, and I would expect you to be able to deal with it. So you have to identify if it is an equity share-based payment or it's a cash-settled share-based payment. You will see the conditions in the question that will enable you to see these things with ease.
Sir,
yes, please.
My question was to ask of the conditions that you've just mentioned. So let's carry on.
All right. Thank you. So let's move on to some terminologies in share-based payment. There are some terminologies that you have to know. But even before then, Okay, let me deal with the terminologies. Let's look at some terminologies you are possible to encounter. I'm going to use a graph to show that one too. So let's be here. Draw this one to this place. Now, it is a share-based payment, and there is a day the transaction happens. You all agree that you bought something for me. Let's agree whether I'll use equity-based or cash-settled based. Let's agree. So the date. So the terminology one, we have what we call the grant date. The grant date. And what is the grant date? It is the date the entity and the employee or any other party. We are talking about people. I'm using the employee as an example. The employee agreed to the scheme, share-based payment scheme. That is the date, the grant date. So at the grant date, typically what you see is number one, the terms of agreement. In the terms of agreement, and also here we talk about the number of employees who will be on the scheme. It's determined here. And the condition, the number of years they will be on the scheme. The number of years. And number 4 here, we are talking about the number of options or rights, the share options. The number of share options or rights that the employee will have. What will be the share options? What will be the rights that you have? That is the first terminology. You have to understand the grant date, and it is the date you make the agreement. Then we have what we call the vesting date. The vesting date. What is the vesting date? The vesting date is the date the employee, who is the counterparty to the contract, the employee becomes entitled. The key word here is entitled. Becomes entitled to receive the cash. If it is cash-based payment, then this is the date he will receive the cash. Or if it is equity instrument, the date the employee exercises the options to the equity instrument. All right, so the date you receive the cash or the equity instrument under the agreement. That is the entitlement date. Then we have exercise dates. The exercise date is the date the employee receives the share-based payment. Or the other party. Please, I've said I'm using employee as an example. It can be a supplier, all right, because we buy things from supplier. This one, we are assuming that the company is buying a service of the employee. The date employee receives, the key word is receives. Please, being entitled to something and receiving it is not the same thing. All right, so understand the different timings. Okay, so that is that. That is that. Then we talk about, so this period that you have, up to this period that you have, this part is called the vesting period. is called the vesting period. So that is the period. So it means that so we, for example, we are having a share-based payment agreement. So I've contacted you as the board of director of my company, and I've said that, okay, your bonus will be based on, let's say I've given you equity settled share-based payment. But you see, today is the day we are making the agreement, and so therefore today is our grant date. But there will come a time that the shares, you will be entitled to the shares, because you have to meet certain criteria. It's not like the day you just became the director, I should pay you bonus. You have to work to the end of certain time to be able to qualify for the bonus. Okay, so the date of the agreement is okay. Then we say that probably if, let's say, today is this year is, let's say, 2022, you qualify to actually lay hold on the ownership of the asset in, let's say, 2024, or let's say 2025. It normally is like the maximum is 2-3 years. They won't give you a question where it is 4 years. That one you have to work a lot. So it means, and you see, it is from 2022 to 2025. What happened is that therefore there will be 2023 somewhere here, and there will be 2024 also somewhere here, which in each of these years you have to prepare a financial statement. All right. So like the one that I made mention of. So let's say if I bought something and it is cash-based settlement, we all know that cash-based settlement is pricing the cash on the value of the share. So if the value of the share as at this time is 4, and it is 5 here, it is 6 here, it is 7 here, it means our liability to be created should bear the fair value at each reporting date. Yes, that is it. But that is different from the equity-based settlement. But before I come to that, what you see is that the fair value over here, the agreed fair value at the grant date, the fair value at the grant date. So we said that over here, that fair value that you agreed, you need to spread the fair value, and that is the important thing. Fair value of the share-based payment, SBP, share-based payment over the vesting period. Over the vesting period. Over the vesting period. Based on, and this is very important to me, please take note of what I'm saying now. Based on the number of employees expected, keyword, expected. You see this thing, you do the terms of agreement, number of employees, number of years, the number of options. You can only know the people who are exercising the option by doing expectation, who are expected to be there to the vesting date. So based on the number expected to vest, that is the most important number. And so this is expected. Expected means that we are going to use some estimations. So the measurement here, we use best estimate, all right? So best estimate. I'm going to use some figures to do some illustration with you by attempting to solve some questions with you. All right, so that is what you have here. So this period, that is what you do, the vesting period, you spread the fair value of the share-based payment over the number of employees who are expected to vest. All right, that is that. So what I'm saying is that we will recognize whether it's equity-based or whatever we are talking about, the number of shares, employees who will vest, because whether cash-based or equity-based, you see, if we are here at the grant date and we are recording financial transaction over here, we will need the fair value. Okay, here I think I made an example that it is 4, if it is cash-based settlement. But how many number of shares are we multiplying the 4 with? The number of shares we are multiplying the 4 with is the number that we expect to be there at the vesting date. since we are not at the vesting date, we need to estimate the number that will be there. All right, so that is what I'm talking about. Whether equity or cash, we need to estimate the number of. So the problem is not about the share price. The problem is about the number of shares we are multiplying the share price with, or 2. So that is what we are talking about. And that one, you need to spread it using, so the total fair value is the number of shares multiplied by the value of the share. So you need to spread it over the vesting period. So over here, let me ask you a question. Over here, because you are not here at the vesting date, you don't know the people there. So who will be there? So you estimate. So over here, you estimate. This, when you are this year too, you are not there yet. So you estimate. Over here, you are not there. So you estimate. But when you get here, you are already here. Do you have to do estimation? Yes, anyone? Do we have to estimate at the vesting date?
No.
Why?
Because we are going to vet. We are going to do that. That's the vetting period.
Yeah. So when you get here, you already know. You really know the number.
Yeah.
So the vesting period is the time between. So when we say something is between something, it's between. It means that. So the time between this date and this date is what we call the vesting period. The time between. So over here, since we are not exactly on the day, the reporting day of the vesting, we actually don't know the number. So we will estimate. Over here, we will estimate. Over here, we will estimate. Over here, we will estimate. But when we get to this place, we already know. So there is no point in estimating it again. All right. So that is the point. All right. So the key things that you are supposed to know that I want you to get here is that, number one, if the equity instrument herein, the shares that we are using, if the equity instrument that we are using and everything that we are using to do the thing now is unconditional or vests immediately, when do you think the immediately will be? Which timing would you think, which terminologies qualify for the immediately?
Grant.
The grant date. So that's the grant date. All right. So the vesting hearing, what we are saying is that if the vesting date is equal to the grant date, the date that we are making an agreement, or is unconditional or anything, then it means that the transaction should be accounted for at the grant date. But it doesn't happen, so nobody will do that. Unless you go outside our world, where people get, there is something called signing on bonus. When you are signing the contract, you take signing on bonus.
Sir, please, are you showing this on the screen, or?
I don't understand.
Yeah, mine is just spinning your name, and then I started screening share. That's all. It's just spinning on it like that. I'm not seeing it.
Please, can you guys see my screen?
Yes, please.
Then please,
The
problem at your end. Kindly check.
Okay, so let me go back and come. Thank you.
All right. So if the equity instrument vests immediately, that is when the grant date is equal to the vesting date. Like I said, some people receive sign-on bonuses, and that bonus can be tied to the equity. So if that is the case, that signing on bonus and everything, you have to account for the transaction in full, everything at the grant date. All right. But The normal condition is that you have conditions before. So if the options are granted, normally where there is a condition upon attainment of some conditions or achieving some condition. A typical condition will be like, okay, you will have to be there for like 2 years, or you have to complete a specific, maybe a specific period of service, let's say 3 years. Yeah, those are the things we are talking about. So here we are talking about service conditions, all right? So service conditions. Yes, then that one, you have to use estimation of number of people. So you have to use what we call best estimate. Using the number of equity instruments. I mean, the employees who will be vesting. Number of equity instruments expected to vest. It is the same as what I'm talking about. The number of employees expected to vest, or the number of equity instruments expected to vest. All right, so that is that. So the key thing is the fair value, the vesting period, then the number of employees expected to vest. So here, the number of years, which is the vesting period, then the number of options that will be vested, the number of employees who will be vesting the options. So these are the 3 key things that I'm talking about. All right, but let me quickly deal with the fair value. Which fair values over here? Which fair? You see this one, the fair value, we have 4. I did 5 here. I did 6. I did like 7 here. Which of the fair values are you going to use? All right, under each timing. It depends on whether you are using equity-based settled or you are using cash-based settlement. It depends. So the fair value to use. So the fair value, let's look at the equity-based or equity-settled share-based payments.
Sir, please, can you go back? Because I was trying to understand what you wrote.
Oh, okay, I hear you.
Okay, I hear you. So just go back and let me pick 1 or 2 things. And then
I'll go back shortly. Let me finish this. All right, so if it is equity-based settled share-based payment, what you do is that you use the fair value at the grant date. You use the fair value at the grant date. Please, if it is equity settled, the fair value does not, and I want to stress on it, ever change. I'm stressing on it. It never ever changed. You will use the, if in the exam they trick you that the fair value changed, I'm telling you that use the fair value at the grant date. Do not change it. I've stressed on it. We will have examples. I will see what will happen. Now, if you are using cash-based settlement, you remember that one is a liability, okay? Because here it is an equity-based settlement. If you say you have given somebody an equity based on a fair value price where it is going to be changing, then it means every year you'll be having changed different equity figure. That is what you'll be having. So it is an equity-based settlement. That's why we say it never changes. You don't change it. Because other than that, your stated capital will be changing every year because the fair value has changed. So you don't change it. in the stated capital. You don't change it in the equity, other equity company. It is the same. But for the cash-based settlement, you remember we said you debit, you see this one, we said you debit the SPL or the assets, and you credit what? Equity. And that is the main reason why this thing will not be changing. Other than that, your equity will be changing. Equity is not meant to be like that. However, liabilities and assets are always meant to be. So for liability, you have to use the present value. For assets, you have to use the fair value. Okay. Even so, IFRS 13 says that the fair value of a liability should be used, which we call present value. It's the same thing. Like the price at which you transfer a liability to another person, who both of whom you and that person are knowledgeable market participants at the measurement date. That is what IFRS 13 says. So the fair value of the liability is what you need. And remember, so here we use the fair value at the reporting date. At the reporting date. So this one, it depends on the fair value of the reporting date you are preparing the account for. All right. And don't forget, we said that over here, you will do what? You debit the SPL or the asset, and you create what? A liability. But the value of the liability is that which is based on the value of the share. So what you are going to do is that what is the fair value at the reporting date you are preparing the financial statement? That is the fair value you use to create the liability. All right. So I'm going to where you said I should go back for you to get from one or two things. All right. Any question? Any question? Any question? All right. So if you don't have any question.
Sir, please go back to the page before the page.
Yes,
the
please.
last page that where we have the cash settled and the equity settled, the fair value.
All right. Hold on. Yes, I think somebody is also saying yes. Any question?
I'm saying that the fair value.
I'll go back. Don't worry.
Okay.
Yes. Somebody too was asking something. All right. Then let me go back to where you.
No, sir, please. There's a particular feed coming.
There's a Daniel. Is that you?
There's a particular feed that keeps coming. I don't know whether it's coming from Thomas or Danny.
No, it will be.
It distorts your voice. So if you can mute, if you want to ask question, then you will mute yourself.
Yeah, I think he has muted. All right. So let me go back to where you wanted me to go. So this is it. All right. So this is it. We are going to solve a question right now. I
think it's Danny or Thomas, one of them.
Oh, are you still getting the feedback? I am Thomas.
Yes, sir.
All right. So please, let's look at this question. Let's look at this question to start with. You already have the question. I've shared it with you.
That's a bit okay.
The share-based payment. I've shared the share-based payment thing with you. So let's deal with the question. Okay, so the question here is saying that an entity has a reporting date in 31st December. On January 1, 2001, it grants 100 shares to each of its 500 employees. Each grant is conditional upon the employee working until 31st December 2003. At the grant date, the fair value was 15. During 2001, 20 employees leave, and therefore it makes the entity estimate that 20% of its employees, 20%, it makes, so it said that during 2001, 20 employees leave, and the entity estimate that a total of 20% of the 500 employees will leave during the 3-year period. So it means that the vesting period is in 3 years' time, 2001, 2002, and 2003. That's the vesting date. And it says that in 2001, 20 employees leave, and the entity estimates that 20% of the 500 employees, these people, will leave during the 3-year period. In 2002, a further 20 employees leave. And the entity now estimates that only 15% of the 500 employees will leave during the 3-year period. In 2003, which is the vesting time, a further 10 employees leave. You are supposed to calculate the remuneration expense that will be recognized in each of the 3 years of the share-based payment. So, but what we've done, we say 2001. How do we, remember, I told you that at the grant date, what are some of the things you look out for? Yes, at the grant date, what are some of the things you look out for?
Terms of agreement.
Terms of agreement.
Number of employees.
Number of employees. All right. The price, the fair value. And the number of options. Okay. So that is what we have here. So they are giving 100 options. And be careful, this is how we are building on it. So if you don't get these things from the beginning, it will be very difficult when we move ahead. And we said that up until where we get to the vesting period, we will be using estimates. But when we get to the vesting date itself, that one we don't need estimates because we already know those people who have left, and therefore the number available for the vesting. So before we get to the vesting date, it is estimation. But when we get to the vesting date, it is no more estimation because we will have an idea how many people have left and how many people are remaining. It is the remaining one who will be there or who are actually at the vesting date. So it means that in 2000, the vesting date is 2003. But we are supposed to do this thing for each of the 3 years. So in 2001, how do we estimate? How do we find the figures? So you realize that they said in 2001, 20 employees leave, and the entity estimates that 20% of the employees will leave during the 3 years. My question to you herein is that how many number of employees are we supposed to? So you see, what I gave you was that, so you find the number of options at the grant date, find the number of options, you multiply it by estimated number of employees who will vest to the vesting period. Then what do? You multiply this one by the fair value. And that is how you get your expense amount. This is where you then debit SPL and you can credit whether liability or OCE. All right, depending on whether it's a cash settled share-based payment or it is a equity-based payment. So, question: how do we find the estimated number of employees in 2001? Yes, please.
Hello, sir.
Yeah.
It's 500 number of employees. Less 20 employees leave. Less 20.
We are saying, so you're saying 500 less 20.
Yeah, less 20. Those who leaves 2021.
Okay.
And it's also estimated that a total of 20% of 500 employees will leave during the next 3 years.
Okay.
So we find 20% on 500. Which is 100.
Okay.
So it will be 500 less 20 less 100 into brackets. Yeah. Am I correct, sir?
Oh, don't worry. I will answer you.
Okay. And then the number of shares and the price will continue.
That one is my problem. But yes, any other person? Any other person? Let me give you a minute to think about it. I'm giving something to someone. Let me just give you a minute. We want to see the number of employees who will be there to vest. That is where the problem is. As for the number of options, you are always given.
Hello.
Yes, please.
So, per the question, it says 20% of the 500 employees will leave during the year. So that means they are no longer with the organization. So to know the number of people,
it's not that they are no longer. They will no longer be. It's an estimate.
Yes, they will no longer. Yes.
Yes.
So to get the number of people who will actually be, how do I say, to get the number of people expected to vest will be 80%. It will be only 80% who will vest.
Okay. So 80% of the 500
number of employees, yes.
All right.
That the people will be expected to vest because 20% is no longer.
No longer. Will no longer. Please use the right because it can affect your answer.
Will no longer
it's
be
an
allowed
estimate.
to vest.
Yes.
Yes.
All right. Okay. Anybody else before I give the final verdict? All right. All right. It's interesting. All right. So actually is the last sentiment, the last suggestion that is correct. Please, the one who gave me this one, I want you to read the thing with care because like I said, this is the foundation. If you get the foundation wrong, it means you'll be struggling going forward. See, read the question. It says that during 2021, 20 employees, this one they left, all right? And the entity estimates that 20% of the 500 of employees will leave during the 3 years. So you that use, if 20, you said 20 people have left. Okay, if 20 people have left, then your remaining percentage can be on 500. Because this thing you did, you've taken 20 out of 500. You are saying 20% of still the 500. Then it means you should reduce this thing to like 480 or something. Because you can't, if it's like doing sampling. If you've already sampled some out, you can't run another probability with the full population again. You can't do that. You can't do that. So what she said is true. It means if 20% left, if 20% is estimated to leave, then it means that 80% is actually the estimated people who we think will be there for the 3 years. Okay, so that is the trick. Because you have said that, okay, 20% have left. Therefore, if 20% have left, then we should be having like 480. Why will you do another 20% on the 500, including those who have left already? So it's something you need to check. It's very, very important to check that. All right. So the number is actually 400, which is 80% of 20% of 80% of the 500. So once you get this, this will be the number who are expected to be there for the 3 years. And when you get that, then you multiply by the number of options. How many options do we have? We have 100 options. 100 options multiplied by what? The fair value, which is 15. There is one thing I didn't add here. Who can tell me? There's one thing I didn't add here for the expense. I said at the grant date, what are the things? Somebody said terms of agreement.
Number of employees.
Number of employees. This is what we found. We found the number of employees.
Number of options.
Number of options.
Number of years.
Number of years. Yes, that is the one I didn't bring. So the number of years is 3 years. So if we are looking for 2021, then it means that it is 1 out of 3 years. Please, are you getting it?
Sir.
Yes, please.
I know that in initial this thing, normally they started with 0/3. I don't know why you are starting with 1/3. It's just a question, though.
Who starts with 0/3? Who? You said normally day. Who is the day? Who is the day?
Okay. The initial period. So that would be 0.
Which one is the initial period?
The first calculation we are doing.
For the first year, do you know that when you do 0/3, what do you get?
It's 0.
Then when you multiply 0 by everything here, what do you get?
It's 0.
So why will you say that? So the first year we should record 0.
Okay. Thank you for the clarity.
All right. All right. So please, when you do this,
they paid your bride price.
How much will you get? Please, the person speaking.
Was holding an iPhone.
Daniel, you keep interrupting. Please kindly ensure some ethical consideration.
My distance is off.
Then who is that? All right. So please let's move on. Guys, punch the figures. Give me the answer.
20,000.
20,000. Yes. Any other person?
200,000.
200,000. Hey, one is 20, one is 200. I want a third person before I record. Yes, one last person.
0.8.
Please, one last person. I want to confirm. Is it 20 or 200?
200,000.
15.
200,000.
It's 200,000.
Okay, so it means in 2001, our double entry will be debit SPL. The expense will be 200,000 and credit OCE 200,000. Okay. What about 2002? Yes, let's see if somebody can get the number of employees right. Okay, this is the English. During 2002, a FEDA, 20 employees leave, and the entity now estimates that only 15% of the original 500 will leave during the 3 years. Yes, English. So how many number of employees? A FEDA
60%.
is what?
60. So it means 60 times 500.
Let me say this one is wrong. You said what? 60?
Multiplied by the 500.
60 multiplied by 500.
But no.
Like this. Is that it?
Yes.
Yes. Please, anybody, you can also give your suggestion. I don't know why people shrink. I don't get it. So if you have a different view, kindly share. All right.
I think it's not going to be 60, but rather 65 because
65. Okay, thank you. I like this when you people come with, varying
because
answers.
the 100 minus the 20% gives us 80%, and then if it's a FEDA, it will be the 80% minus the 15%.
The FEDA is not a percentage, it's a number.
It's a number.
Yes, it's not a percentage. You can't take 20 out of 80%. No, read it well. A FEDA 20 employees.
So I did the 80 minus the 15%. That was how come I got the 65.
Okay.
Oh, okay. So you said you have 65%.
Yes.
No problem.
I don't know.
Any defect? Oh no, don't worry about whether it's right or wrong. This is a class. Don't worry.
It should be 85% times 500.
Good. You also have. Yes. So give us like that.
So it's a further 20 employees leave, and the entity now estimates that only 15% of the original 500 employees. So meaning it will be 85% times the 500.
85 of the 500 will be staying. Okay. Yes. Any other person? Any other person? So we've had somebody say 60%, somebody say 65%, somebody say 85%. Yes, any other?
I think it's also 85.
Okay. So we've had 285. Please, who is this? Yes, the person who just spoke last. Is it Bintu?
No, sir.
No,
Sir,
Sheila.
I have 75%.
Sheila.
All right. Okay. So my wife decided to talk. That's the meaning. All right, no problem.
So 75%.
Okay, another 75%. This is interesting. So we have 60, 65, 75, 85. All right. So the thing is that please be mindful. In estimating the number of employees who are expected to be there, you have to be very, very careful. It's a matter of English. It's not anything accounting or anything. I think the ladies should be able to understand it better, because I always say, ladies, your English are better than the gentlemen. So what it's saying is that a further 20 leave, and the entity now estimates. So it means that the people who are leaving, the further 20 that leave, has caused the entity to revise their estimation of 80%. That is what this statement means. So it says that 20 people leave, and now the entity estimates only 15% of the original 500 will leave. All right. So please, it's 85%. of the 500. So this is where the problem is. So there, it means that you people have to be very careful how you deal with this area. So it will be 85% multiplied by 100 options. 100 options. And I said that the fair value of an equity-based settlement doesn't change. Do you remember? So it will still be 15. It will still be 15. And you multiply it by what? We are in the second year, so 2/3. But be careful when you do this. How much will you get? 0.85. You got how much?
425,000.
425,000.
Yes, please.
All right, so 425,000. The trick here is that this thing is a cumulative figure. The person who said we always start with 0, probably you wanted to give me something. It's just that the expression is what is wrong.
Yeah, it's done. It's done. It's done.
Yeah.
I said we start with 0.
It's just that the expression is what is wrong. So you say, I know what you wanted to say, but you didn't say it well. Okay, so it means, let's say you start with 0 like this. So it means that this figure you had is the one that is going to your balance sheet. And the difference between 0 and this one, 200 and 0, will be the one that will go to your P&L. That is what probably you wanted to say. And that is how we express it. So I knew that you wanted to say something. It's just that I know some of you have gone to classes and probably have some differing views of how these things work, but that is it. So if you want the P&L figure, you will deduct this one from 0 so that you have your 200. In the same way, in the second year, you will deduct this one from this so that you know what to go to the P&L. Okay, so you see in balance sheet, we record cumulative figures. In SOFPs, cumulative figures. It's not year figures. Just like you see, that's why the balance sheet is called SOFP, Statement of Financial Position, as at. That as at means that what you have accumulated up to that point. And the P&L is Statement of Profit and Loss and Other Comprehensive Income for the year ended, specific year. All these things are taught in senior high school, unless you forgot. So that is the difference. In fact, I remember in my senior high school days, they asked us to distinguish between why P&L is for the year ended and why balance sheet is as at. That is the meaning. So these figures you get is the as at figures. So if you want to get your P&L figure, that is here. What you do is that you have to subtract it. So you get so your SPL, your expense, you have to take away the 200 from the previous year and get like 225,000. This is what will go to your expense. That is what will go to your expense. But this is what will be in your other equity component. So you realize that this year, you see, this one will be other equity component 200. This one, other equity component 200. So in the second year, it will be 425. But you can cumulate balance sheet. You can't cumulate P&Ls because it's for the year. All right. So that is that. So let's figure out 2003. It's getting interesting. So in 2003, they said a further 10 employees leave. So what would be our number of employees? Yes, who can try? Yes, Abna.
So does it mean that when you are posting the transactions, it means that now the SPL is going to be 225? Is that what it means?
Yes, please. Yes, please.
And then the OC will also be 225.
Yes, please. I'll show you. We'll post it now. You see how it will be.
Okay. All right. Thank you. I'm not answering your question.
I thought you are going to answer my question.
No, because I don't know.
Please, who can try?
So the number of employees will be 450.
450, exactly. We will do 500 minus 50. Somebody is asking why 50. I told you that when you get to the vesting date, it is no more estimation because you already know the number of people who have left. Here, a further 10 have left. We have 20 who left. Then we have another 20 who left here. So it makes it 50. So it's 450 multiplied by 100 options, multiplied by 15 CDs. And here we have 3/3. All right. And that one will give us how much? So when you get to the last year, it's not about percentage, unless the question is posed in a certain way. But when you get to the final year, I mean, unless the question says in the final year, 80% left, the word is left. So that one, you know that you have to use 20%. All right. So now, what will be our answer? Oh,
675,000.
675,000. So how much do you think will go to the P&L?
Minus 200.
Yes, how much do you think will go to the P&L? So let's pass the John.
250,000.
250,000, yeah. So the question will always ask you to show how it will be in the financial statement. So you have, let's say, the extract of the financial statement. In the SPL, you have, let's say, 2001, 2002, 2003. So in the SPL, you have a staff cost. This is a staff expense, staff cost. First one, we had 200. P&L, the second one is 225. Then you say this one is 250,000. Then the SOFP, you will record other component equity. Over here, it will be 200. Over here, it will be 425. And we had 675. So that is it. That is it. Okay, so basically that is it. All right. Now, I'm going to let you do another one. I actually have to educate you about market base. Okay, so let me talk about the market base so that we can look at another question. Then after that, I think I will pause here and do a part 2 of this class on Saturday. All right, so that we can conclude on it. But let me just test you on something. There is another question. All I want is the number of employees. All I want is the number of employees. So I just want to see if you can really do it. We are just looking at the side of the number of employees. So this one says that on January 1, 100 employees were given 50 options each. 50 options each. This will vest if the employee still stays at work on 31st December 2002. This is a what we call non-market based condition. We will look at them. We will look at them. On January 1, the fair value of the option was 1. The share price on 31st December 2001 was 3. It is considered unlikely that the share price will rise to 5 by 31st December 2022. 10 employees left during the year, and a further 10 are expected to leave in the following year. I mean, this thing is the terms of the agreement. The grant date is this date, right? What is the vesting date? What is the vesting date? Yes, what is the vesting date? Hello? Please, what is a vesting date? What did I say vesting date was when I was explaining it?
That is the end of the agreement, when the agreement expires.
So when, in this question, when is the vesting date?
That is the third year.
Which third year? Please, what is the date? Give me the date in the question.
That is 31st December.
31st December 2000.
So why are you saying third year? All right. So this is the vesting date. Now that you know the vesting date, I just want you guys to help me figure out the number of employees who will be there to vest by that vesting date. Using this part, 10 employees left during the year 2021, and a further 10 is expected to leave in the following year. So what will be the number of employees? Listen, the question is requesting that you do this as of December 2021, 2001. But I just want the number who will be there.
Eight.
80. Please, that's you, right?
Yes.
All right. Yes, who else?
It's 80.
80. Please, why are you guys saying 80? Help
Sir,
the
I think
others.
it is, sir, I think it is 90 because the question is asking for 2001.
Okay. All right.
Because
Thank
it says 10 employees left during the year ended 2001. So if it's asking us to compute for 2001, it will just be the 100 minus the 10 people that left in 2001 and not adding the.
But you see, it is not about those who live in a particular year, it's about those who will be there to the vesting date. That is why we estimate ahead.
Okay, so you include that of the 2002.
Of course, you do a best estimate.
Okay.
But the question we did, you see, so then here you should have told me that, oh, this one that they said it is estimated that 20% will leave. You should just use these 20 people who left and not be bothered about the estimate of the further one in the following years, because we were looking for only 2001. Please, are you getting what I'm saying?
Yes, please.
Yeah. So the estimate is not because we want to know the people who are living in that very year perspective. It is those who we expect to be there to the vesting date. And I know this. See, this thing is not accounting. No, this thing is English. So it is very difficult for me to help you. I mean, teach you how it will work, because it is a statement that can change anytime in your exams. Yes, it's a percentage. It's English. This one is like on January 1, 100. We have 100 options. Then they said that 20%. What I am asking for you to look for is a best estimate of how many people the company think that will be there at the vesting date. The best estimate. The best estimate. That is what the accounting side is. But as to how you manipulate to understand the English that is giving you in a question, I don't think there is an accounting way I can help you to identify. It's English. That one is a pure English stuff. So they said that 20 employees leave, and that one makes the company estimate that 20 employees, 20% of the employee will leave. So you have to use the percentages over here, since you are making estimate of how much of people you think will be there. So here in English wise, this 20% is the one that is helping them to make the percentage. Yes, this 20 is the one that is helping them to arrive at this percentage. And when you read here too, it said a further 20 employees leave, and the company now estimate that only 15% of the original 500 English, original 500. If it has said that company now estimate that 15% of employees will leave without the original 500, then it means that when we are here, we need to take away the 20 who have left already. Then we will now do 50% of the remaining people when we come here, because in 2002, we already know that 20 people have left. But it's English, it says that 15% of the original. And over here, like I said, when we are at the vesting period, I mean, that one, at the vesting date, that one, we don't need estimates. We just need the reality. So over here, it's simple. It says that 10 people left during the year ended 2021. And that one, and a further 10 is expected to leave. Okay, a further 10, a further 10. So it means that you need to take this 10 aside and do another 10, a further 10. So if this one has been 10 employees leave in 2001, and the entity estimate that 10% will leave, then we will just do 10% of the 100 employees and move on. 10% of the 100 employees. But this is English. It said 10 left. And the company estimates that a further 10 are expected. So in all, how many have left the 100? So are we thinking we'll leave the 100? So this 10, the 100, 10 is already gone. We now expect a further, English, a further 10. So that makes us have 80. We just take that one. We multiply the things. And here, I think there is something I need to, in fact, even without teaching, I think I've already mentioned it already. So here, my question to you will be that, okay, we have 50 options. That is what we have, 50 options. This is it. But what will be the fair value we need to multiply this way? What will be the fair value? Yes, who can help? And the number of years, this is the one out of the 2 years. So, but who can help me with the fair value? Because this question says that if the share price, and if the share price on that date is 5, that was the agreement. And they said that on January 2001, the fair value was 1. And the share price of 2000 at ending 2001 is 3. So it means as if the fair values are plenty. You have 3, 1, 5. And this is a share option. So a share option falls under which one? Is it cash settled or equity?
Equity.
And if it is equity, which fair value should we use?
5.
5. Explanation.
It doesn't change, as you told us.
So which fair value is that? Somebody also said 3. Who said why? If I tell you that it is 1, will you agree?
Yes, it's 1.
Yes, please.
Why will you agree?
Because of the 2001, that means
okay.
One is
Fair value of the option was 1.
Oh, the fair value of the option is 1. It is also 5 here. It is also 3 here. But I'm asking why do you think I selected the 1?
So I said the date is on 1st January 2021.
And what is the technical name for this date?
A grand date.
The grand date. So I told you that if it is an equity-based settlement, you use the fair value at the grand date. It never change. You see, I told you that we will encounter this thing.
Yes,
sir. Remember?
Yeah.
So you see where you are started drifting.
Serious.
These are the things in exams.
Okay.
You will get an example of cash settled, and I will see what you will say there. That is the exam. So this is the things that the small things that we say that keep notice of. Because this question, all that they've done is to bring in plenty fair values just to confuse you. In fact, it's even 4. I thought it was 3. 1, 2, 3, 4. So the issue is that which one are you selecting? So it's about picking the fair value that solves the problem and the number of employees. So please, you have to really work on that one. Let me see. I'm closing the class for now, but I want to find out if you guys have actually understood how we calculate the number of the employees. This matter of English. Okay, I think I found one that I want here. We are just doing those parts. I mean, we will look at the, we will continue and finish on Saturday. Okay, all I want from you is to help me identify the number of employees and which fair value applies. So this one says that an entity grants 100 shares to each employees of 100 share options to each of its 500 employees, provided they remain in service over the next 3 years. Condition. The fair value of each option is 20. During year 1, 50 employees leave, and the entity estimates that a further 60 will leave during the year 2 and 3. So please, year 1, how many employees will be there? Yes. Yes. Come on, guys. English.
What will be 500 minus 50 minus 60?
Minus 50 minus 60. Is it true? Yes, any other person?
That is not for year 1, sir.
So what do you think is for year 1?
So I think it's 500 minus 50.
Okay, somebody is also saying 500 minus 50.
So it's 500 minus 50 minus 60.
Okay, so I have 2 people here, 1 person here.
It's 500 minus 60 minus 60.
Minus 60 minus 60 twice, or 50, 60.
No, it's 50.
So I have 3 people here, still 1 here.
500 minus 60 minus 60.
2 60s.
Yes.
So where did you get your first 60 from? Because we mentioned 150 and 60. You are even throwing up. Wow. Yes. Oh,
okay,
guys,
so it should be 500 minus 60.
Minus 50. The year
minus
1 is
60.
500 minus.
Okay, somebody is also saying 500 minus 60.
No, I said minus 50. Year 1.
No, there was somebody who also said, I know yours is.
Oh, okay.
All right. Last one.
The year 1 will be 500 minus 50.
This one.
Yes, please.
Okay, somebody has put something in the chat box. Okay. Hey, Senior Emmanuel, you've not approved my loan. All right. 500 minus 50 minus 60. Anyway, this is the correct one. All right. See, it's English. English. 50 leave. And the entity estimate that a further 60 will leave. So it is that, like the one we said, 10 have left. A further 10 is expected to leave. That is it. See,
I said, you see the confusion
Out of the 2 years and the 3 years.
We will do that. Don't worry. We are taking it step by step. So don't worry. Please, any other question?
I said, I want to understand something. With regards to the number of employees who have left the organization, is it from the grant date till the vesting period?
Yes. But you see, we are looking at every year and its own, because you can't use, we have 2023. That's where we are. We will be in 2024 and we'll be in 2025. You cannot use people, if you are in 2023, you cannot know the people who have left in 2024 unless you are in 2024. Are you getting it?
Yes, sir.
But you can only estimate for those people who will be leaving in 2024. Are you getting my point?
Yeah.
But when I get to 2024, I know that. So that one, I won't go back to estimate for any 2023. I already know. Then in 2024 too, I will know. So if I'm in 2024, I can know how much I've left in 2023 and how much I've left in 2024. I can now only estimate for those who will be in 2025. So when I get to 2025, which probably is the vesting date, I don't need no more estimation. I just need the actual people who have left to subtract for the number of employees. That is the mechanism in this. So I think what is confusing you people is the first one we did. And that I go back, it is the English. It is the English. It's not, so because it was percentages. This one said 20 left or 20 employees leave. And the entity estimates that 20% of the 500 will leave. So it makes this 20 useless because it is a percentage of the 500.
Yes. I said it pertains to only 2021.
It pertains to only 2021.
And comparing this same statement to the current question that we are answering.
That one is not a percentage.
It's not a percentage, but then
no, watch this. The entity estimate that 20% of the employees will leave during the 3-year period. Please, did you see that?
Okay.
So the 3-year even includes the 2021 itself, 2001 itself. Are you getting it? It didn't say 20% will leave during the remaining 2 years. No. It included the year itself, the year that they were in itself. And you came here and you said that a further 20% leave, and the entity now estimate that only 15% of the original 500 will leave during when? The 3 years. You see, that's
for the whole vesting period, sir.
Yes. So here you only applied 15%, meaning that 85% will be there to vest. But when we go here, it said 10 employees leave. Like I said, once you get to the final year, you don't need any estimate. You need those people who have actually left up to the time so that you can subtract to get those who will be there. So you do 20, 20, then the 10. That is all.
Okay.
I think the percentage came in and it's confusing you. All right, this is where we were, right? Okay, so who can help with year 2? So it says that year 1, 50 leave and a further 60 employees leave during the years. Have you seen how this one was quoted? During the years 2 and 3. All right. And then this one said at the end of year 1, the entity reprices the share option because the share price had fallen. That is not my problem. I mean, as for the share price, we will talk about it later, maybe on Saturday. But okay, let's look at this is where I'm interested in. During year 2, a further 30 employees leave, and the entity estimate that a further 30 employees will leave during year 3. So, who can help? Who can help?
I want to try.
Oh, always try. This is a class.
So, sir, please, it will be 500 minus 50 minus 60 minus 30.
Minus 60 minus 30. Am I correct in what you wanted?
Yes, sir.
Yeah, any other person? Okay, somebody has put something in the chat box. 500 minus 50. Okay, you must said 500 minus 50 minus 30 minus 30. All right. Okay.
Sir, yes.
Oh, you also agree with Ima?
Yes.
I didn't give you a loan, or if that's the reason why you are. All right. Yes, anyone? Any other person? I have two answers.
Hello, sir.
Yes, please.
500 minus 60, minus 50, sorry. Minus 50, minus 60,
Minus
and
60.
the year 2 minus 30, and a further 30.
No. Please mention the numbers well. You are confusing me. 500 minus what? 50.
Minus 50, that is the employee leaving for the year 1, and a
Minus,
further 60, and a further 60 for year 1.
And a further 60 for year 1.
And the year 2 will be the 30. And estimate of 30.
Estimate of 30. But let me ask you a question.
I'm trying.
No, don't worry. I'm helping you. This one, it was an estimate in last year. When you come to this year, do you really need the estimate of last year? Because the moment you get to the next year, you can't use estimate of last year. I mean, you already know who have left. So
yes.
So what if you think about it carefully, you don't need this estimate of last year.
Okay, then it will be the 30-30.
All right. Yes, any other one? Yeah, so those of you who said this one is correct, that is it. Please work on this, or work on your English. It's very, very important.
Serious, sir.
Yeah, because they say accountants, you people inquire. Yeah, so that is what they said. So they said
technically share-based option is getting us.
But please, I am of the view that get ready. It's either employee benefit or share. You always get one of them. You always get one of them. Because these are the level 3 standards. If they don't examine any, I mean, then it means that they are trying to tell us we should not be teaching the standard. So as for this one and employee benefit, definitely you get one. If you don't get it in CR, you get it in advanced audit and assurance. So that is that. So please, it's English. It said that during year 2, a feather, which means that the 20, where are you? The 50 who left, a feather of that 50, 30 employees is leaving. And the SCT now makes the estimate for the next year, which is the 30. All right. So it is 500 minus the 50 minus the 30 one. So there will be a day when I finish teaching this, and we will come back to solve this same question. And some people will still get it wrong when we get there. This same question, you think, okay, so the last year, during year 3, 30 employees leave. We are closing with this one. Yes, who can try? Who can try?
500 minus 50 minus 30 minus 30 is the same.
It will be the same. 500 minus 30 minus 30. Hey, 500 minus 50 minus 30 minus 30. All right. Please, do you agree?
Yes.
I agree. So that's that. Because over here, we don't really need the estimates anymore. We need the actuals. So because the last day, so 30 have left, 30, then the 50. So that is that. All right. I think somebody dropped. Yeah. So thank you. Thank you. So please work on the English. You already have this question in your page. What I'm going to do is to update it, add more questions to it, like the way I did with the employee benefit. I'll add more questions, add the past questions, and I'll share to you. Please, once I'm done with share-based payment and we've already done employee benefit, the rest of the standards, it will not be like this that I'm teaching them. We will be solving questions. All right, because like I told you,